Let's talk about how to position from here. Joining us this morning, Sonders, Charles Schwab, a chief investment strategist. Lizanne, good morning. Good to have you.
Nice to be here. How are you, Carl?
It's an interesting morning for us because there is so much policy discussion, even as we're in the middle of getting some corporate commentary about the quarter. I wonder how much uncertainty you think that feeds into at least the rest of January.
Well, we may have alleviated some of the tariff-related uncertainty in terms of what got announced on day one, but it was even later in the day on day one that the administration came out and said they're still planning on going ahead with tariffs on imports from Canada and Mexico. So I think that's the one page from the 2018 playbook that is relevant this time, is the uncertainty associated with just how and when these policy announcements get made. But, you know, it helped allow for a turnaround in the equity market. You've generally been seeing the dollar trending lower, at least over the past 8 days since the recent peak. And on a day like today, with yields down sub 4.6% on the 10-year, I think that's helping to give a lift to the Russell. But the uncertainty is not past us for sure.
Are you surprised at the way the market, or at least the bond market, has taken tariff headlines or the lack of tariff headlines and processed them into lower yields?
Well, that's just, a day's action. And I think we have to remember that although volatility has been subdued in the equity market, at least as measured by an index like the VIX, it has not been subdued in the fixed income side of things if you look at an index like MOVE. So I continue to think that we're going to see volatility in Treasury yields tied to policy, as well as the actual incoming data, both on the inflation front and on the employment front. And I think that is a feeder into equity market behavior. We've got different thresholds that tend to cause problems for the overall market versus, say, just small caps, which do have that heightened sensitivity to moves in yields because those smaller companies tend to have more variable rate debt. So I think these day-to-day gyrations are going to be with us for a while.
Right. I assume you think that pain threshold on the 10 is around 5. It was interesting to hear the former Treasury Secretary with us a moment ago thinking maybe the administration can work that down to maybe 3.5.
How? I think that's the obvious question is how one can go about doing that, because all else equal, the combination of proposed policies on immigration and tariffs, again, all else equal, puts downward pressure on growth, but upward pressure on inflation. And if we look at the immigration side of things, the constraint on workforce growth, that also is all else equal, puts upward pressure on inflation. It's hard to envision a scenario like that if it comes to fruition, allowing for yields to move down from, call it 4.5% to 3.5%. That may be the stated goal, but I think there would have to be a change in some of those policies.
Finally, Lizanne, do you think the tax issue in the scope of the whole year will be the most important question for equities?
Possibly, but not to the same degree as we saw the benefit of the 2017 tax cuts accrue to the equity market and to the economy, because we're now just talking about the extension of the 2017 Act, not a whole new round of tax cuts. And I think that's why you may be seeing a little bit more muted action on the part of a lot of the survey data with regard to tax policy. I think there's less optimism because we're dealing with an extension, not a rash of brand new tax cuts.